five categories of mutual funds in altogether, which has been introduced by SEBI: equity, hybrid, debt, solution oriented, and others. So these are the five broad categories in which the mutual funds have been divided. And this classification was given by SEBI in way back in 2017 to streamline the mutual fund industry. Now, instead of investing directly into the stocks, because when you invest in stock, you should have complete knowledge. Which stocks are going to give you a good return, and when to enter, when to exit the stock. So it is a little bit requires a lot of analysis. And once you get busy in your own work, so you don't want to be bothered about that. So instead of investing into stocks directly, you can invest in mutual funds because they are managed by the fund managers who take care of where to invest and when to exit. And they keep looking for opportunities. When they think that the stock is going to underperform, they normally exit the stock and then enter into fresh new stocks which are going to give good returns. So they are professional managers and they are doing the job which you are supposed to do. But since you don't have so much of time because you're involved into your own business or you're working in a company, so that is one. And then the second benefit is basically the benefit of diversification. Because when you invest your money and buy mutual funds, even if you have put 10,000 rupees in a mutual fund scheme, your amount is invested into 30, 40, 50 stocks. So diversification reduces the risk. Okay. So do you know that diversification reduces the risk? Anyone? How does it reduces the risk, diversification? I'm asking this question.
So since you diversify across different asset classes, if for example equity is going down, then maybe gold is going up. Your portfolio is protected
Okay.
all throughout any
Fine. So can
market
you just repeat?
condition.
Actually, I was just trying to increase the volume. So who was there? I mean, was it Shrishti? Okay. So what you are saying? Uh,
So Srishti, so I said if you diversify across different asset classes, your portfolio is more protected across different economic conditions overall. For example, if one day equity markets are down, then if you have gold in your portfolio or you have debt
Okay,
in
so
your
that's a good
portfolio, it's
point,
still
but
protected. You
it
still have
talks
some
about
sort of returns
investing
that are
into various kinds
positive
of
in
assets.
nature.
Now you can put your money in a real estate. You can put money into financial assets like buying bonds, shares. Okay, so you're diversifying your portfolio, and that is what everybody does. But if when you are investing into suppose in equities only, so how do you diversify basically? Like when you're given your money into a mutual fund manager, and he is going to invest into various kinds of stocks, so he diversifies. So that reduces the risk. So what is that risk basically? Can you explain? Anyone? Shristi, I mean, you said something, and can you just think about in when we talk about stocks?
So in terms of equity, it could be regarding industries. If you diversify across different industries, again, so for example, some industries are
Yeah,
cyclical in
definitely.
nature, some are
So,
not. So
just
through
to
that,
talk
you again
about,
protect your
whenever
portfolio.
you invest your money, so you take risk, okay? And when you diversify, like, I may talk about, when I had invested my long back, about, 15 years back. Of course, I've been investing quite some a long time. So, I had invested a lakh of rupees in Maruti. It was way back about 10 years back, okay? And though I've been investing in mutual funds, so I bought, a stock of Maruti, and that time it was, trading at 1,000 rupees. Of course, now it is close to about 15,000 rupees. So, so when I bought, say 100 shares or 1,000 each, so I put 1 lakh rupees into Maruti. Okay, and I was of the opinion, and I learned that Maruti is going to do very well, and I had invested. But what happened? Within a week time, the stock crashed to 500 rupees. From 1,000 rupees, it became 500 because there was a strike in Maruti, and some workers died, and Maruti plant remained closed for about a month or so, and there was a lot of uncertainty regarding the company. And I had invested 1 lakh rupees, and it became 50,000 rupees. Now, that is of kind of a risk which is associated with a particular company, and this is called company specific risk. Okay, So that is called company specific risk. So if I had not invested, just I had suppose instead of investing 1 lakh rupees in Maruti, I would have invested say 5,000 rupees in 20 stocks like Reliance, Infosys, and everything. No, I mean, the company specific risk would have been diversified, isn't it? So I would have not lost a big sum of money, like, losing almost 50% of my money in just, just 15 days time. Okay. So have you understood this? I mean, the risk gets diversified if you are, investing not only one stock, but investing into, I mean, maybe 10, 15, 20 stocks. So the sometimes what happens, the company specific risk cancels out. Some companies may do well, some companies may underperform. Because of Maruti there was a strike, but Reliance might have done very well because of its own strategy, or some kind of oil discovery, or something which happened particularly to the company, and company gained a kind of its stock appreciated. So if I have invested in 20 stocks, maybe 10 would go up because of their own reason, 10 may come down. So I will be basically, diversifying away the company specific risk. So which means that, I will not be making any money as such if I remain invested into, say, 20 stocks, because the company specific risk goes off from my, this thing, risk. But there is another kind of a risk which is called the market risk. That is basically because maybe there's a good the interest rates came down, or all the macroeconomic factors, they are doing very well. Country is doing very well. India is growing, GDP is growing, so we have very good lot of reforms which are happening. Because of all those reasons, all the stocks will get impacted because of that. Some may be more because with this GST kind of a reform which has happened, Maruti has gone up by 20 to 25%. If you look at Maruti, for example, let's say screener. Okay, so let's take Maruti Suzuki, and let's look at the chart of Maruti. So if you look at the chart of Maruti, Maruti has touched 16,000, where it was about a month back it was 12,840. Now it has gone to 15,000. But if you look at a company like Reliance, okay, then or we can just say that Maruti has I mean, if you look at the return of Maruti, so in the last 1 year, how much return the Maruti has given? The return has been last 1 year is 26% of Maruti, and partly it has happened in after the GST reform, it has zoomed by about 5 to 6, 7, 10%. Okay, so it has given a good return in the last 1 year because of so many factors. But when we look at a company like Reliance, okay, so if you look at Reliance, what happens to Reliance? Reliance is underperformed. Even after the GST announcement, because GST is not impacting so much on Reliance. Maybe it is a well diversified company, and almost like 50% of their revenue comes from oil business. So where there is no GST on petrol. Okay, and of course it is doing some other businesses also like Geo, telecom business. There also there is no change in the GST rates. And then some retail businesses, there would be some changes there. Okay, but it has not been so much impacted by the GST. So you find that some stocks go up, some stocks go down because of the macroeconomic factors. Okay, so the risk which you take because of this reason is called the which risk is it called? The market risk. Okay, actually I'm running out of battery, so I'm just going to change the this thing. Just hold it.